Why you should open a reverse mortgage line of credit now as opposed to waiting till longer. We're going to answer that question for you today because it's a big deal. And if you don't understand how these reverse mortgages line of credits work, I think you'll be missing out on a pretty good opportunity for your retirement planning indeed. So don't forget to subscribe, my friends, here to Heritage Wealth Planning YouTube channel. Heritage Wealth Planning, look at that, my own shirt. Then click on the little bell to be notified for future content. Thumbs up and comments always help me. So let's go back, and this is my man Don Graves' website at HeckhamAdvisorsGroup.com. Don's a well-known guy who I subscribe to his website and his email list. You should too. It's free. A lot of stuff on reverse mortgages. That's all he does. And this is he interviews Wade Pfau, Dr. Wade Pfau. And again, Wade does the book on reverse mortgages. And I'll put a link in the show notes, which you should absolutely get. Reverse mortgages. How do you use reverse mortgages to secure your retirement? Make sure you get the updated 2018 because the laws did change pretty significantly in 2017. All right, so we're going to talk about this. So now Wade had written an article in the Forbes magazine, and he talked a lot about reverse mortgages, but he didn't talk as much as I was hoping about using a line of credit, an untapped line of credit for future use, and why you should start that line of credit earlier, even if you don't intend on using it for some time. So let me give an example. I had a lady email me, Mary, and she goes, hey, we're going to stay in our home, but we don't want long-term care insurance, but we're thinking about reverse mortgage as a way to offset the cost of long-term care if we need. Any thoughts on that? And I was like, yeah, absolutely. Get a reverse mortgage line of credit and start it. And she didn't tell me, but a lot of people say, it's too expensive, blah, blah, blah. Just wait till you need it. And no, you don't wait till you need it. If you're going to stay in your house, you think you're going to be in there for the long run in retirement, why you don't get a reverse mortgage line of credit, I think is a big mistake. I absolutely do. You should get it now. And we're going to go over why Wade tells us that explicitly here. So Wade gives us an example. You're 62, you got a home value of $250,000, which you expect to appreciate at 2% a year. All right. So someone who's 62 today, they'll get a current interest rates now. They'll have a principal limit factor of basically 52%, which means they can borrow. Actually, I think it's 48%. What was a PLF? It's 48%. We'll get into that in just a second. Yeah. So they can borrow 48% of the fair market value of their home, or they can have 48% loan to value, if that makes sense. So if you're currently carrying a mortgage, you can't have more than 48% debt against that $250,000 home to get the reverse mortgage line of credit. You just can't. That's the way the principal limit factors work. And we'll talk more about how that works actually in here just a second. So in this case, let's say there's no mortgage. You have a $102,000 is your PLF, your principal limit factor. By the time you're 90 years old, if you never took a loan against it, you'd have $351,000 available to you to do whatever you want with. You could go blow in Las Vegas. You could send money to old Josh. It doesn't matter. Don't do that. I'm just joking. At the age of 62, the reverse mortgage makes $102,000 available. If the proceeds are left in the line of credit, they're not taken out and allowed to grow until 90, it'll be valued at $351,000. But what if we wait until we're 90 to take the home equity line of credit? No, the reverse mortgage line of credit. At that point, with a 2% appreciation, the value of the home would be $435,000. Our proceeds on the reverse mortgage line of credit, though, will only be $284,000 as opposed to $351,000. And this is what they show us. Here's if we wait, the yellows, we wait longer to take the reverse mortgage to open it. I guess that's turquoise, is if we take it earlier, and you can see the amount is available to us grows. It starts to grow. Even the delta increases. The gap widens and widens as we get older. And so what happens is the younger you take it, the more you have outstanding to you in the future. And again, the home value appreciates at the same 2%. So the home value is irrelevant in this stage. All right, so Wade's message is this: opening the line of credit earlier allows for greater availability of future credit relative to waiting until later in retirement. And there's a video that Wade does when he's being interviewed by my man Don. And Wade is my man too. Never met either of these guys, never talked to either of these guys, but I'm a big fan of both of them. I love what they're doing for this part of retirement planning because I think it's very, very overlooked. People like Dave Ramsey think they're scams, and for the love of me, I don't get that. How do increasing rates affect the reverse mortgage? The factors that determine the initial borrowing capacity, that's your principal limiting factor, relates to your age and the interest rate and the expected rate. We'll talk about that in just a second. So remember, there's three things that determine your principal limit factor. The PLF is how much you can borrow. That's all there is to it. The line of credit you're establishing or that you can use to pay off other debt. Higher interest rates mean less borrowing capacity. So this can be advantage of a reverse mortgage in a lower interest rate environment. It's a present value calculation, pure and simple. With a lower rate, you have a higher present value. A higher rate, you have a lower present value. The idea is that the home is collateral that will be used to repay the loan balance. And if you don't want the loan balance to, okay. So what they're showing us here is they're saying, look, we have 4 different interest rates. We have 3, 5, 7, and 9. And so at 62 years old, which is the earliest you can take a reverse mortgage, when a 3% expected rate, and the expected rate is a 10-year LIBOR swap plus the lender's margin. You can go on Wade's website at retirementresearcher.com. He updates it daily. It's awesome. So at 62, your PLF in this case is with a 3% expected rate is 52%. At 5%, your PLF is 40%, and probably 42%. At 7%, your PLF is 32%. And then at 9%, your PLF is about 25 or so. That just simply says if I had $100,000 in my home value, at 3%, I could borrow $52,000 from it as my line of credit, if that makes sense. If the rates are at 5%, I could borrow $42,000. If the rates are 7%, I could borrow $32,000. If the rates are 9%, I could borrow only about $20,000 odd. So with the lower interest rates, you can borrow more because it's expected that the loan balance would grow more slowly over time. That's just all there is to it. Because the interest rates are less, that means I have less loan to repay. And so from the chart, you can see how that works. The lower the interest rates, the more the loan balance. That's all there is to it. So if the interest rates do increase a little bit, you can see how it can take potentially quite a long time before you get old enough to have the same principal limit factor as you do with the lower rates in today's age. So what I want to point out is here with a 3% interest rates when you're 62, your principal limit factor is 52%. You don't get above 50% for a principal limit factor until, let's see, until at the rate of 5%, you are 76, 77 years old. At the rate of 7% until you're about 84, and at the rate of 9% until you're about 88 or so. So you never get that high in terms of principal limit factor ever, even of higher rates, even as you're getting older. The way to get the higher principal limit factor, i.e. the more the loan you can borrow, is to do it while the interest rates are low. That's all there is to it. We're going to skip over this October 2nd rule change because it's literally water on the bridge now. So let's see. All right, so then he talks about how does the line of credit growth work. There's something called the principal limit factor, which we just talked about, and that's the borrowing capacity of the reverse mortgage. The initial principal limit factor is just what percentage of the home value you can borrow against, and that's always going to be equal to the equation that we'll talk about here. All right, so you have the principal limit factor. Then you have the amount, which is the amount you can borrow. All right. Now you have a loan balance and you have the line of credit balance. So yeah, if you have $100,000 is your house value and your principal limit factor is 50%, that means you can borrow $50,000 from it. Thus, if you borrow $25,000, that means your loan balance is $25,000 and your line of credit is $25,000. And both of those are going to grow at the same rate each and every year. They're going to grow at the expected rate each and every year. They're locked in. So if you never pay it back, if you never pay any money back, what's going to happen is the principal limit factor is going to grow by a certain amount, and the ratio of the loan balance to the line of credit balance will grow at the same thing. So always be 50% against the loan, 50% against the line of credit at an increasing rate of whatever the rates are as it goes forward in the contract. They'll always be the same. Now, if you want to pay down the loan, then your line of credit will be higher than the loan balance. So you could have a loan balance essentially zero, and your line of credit would be 100% of the principal limit factor, which again is, in this case, is 50% of the fair market value of your home. On the other hand, if you borrow 100% against the principal limit factor, your loan balance is 100% of that principal limit factor, and your line of credit is zero. You have no more borrowing capacity. But either way, those two things are going to grow at the exact same rate. So what that says is if you don't have anything outstanding, your principal limit factor is growing at a certain percentage each and every year. In this case, because you have no debt outstanding, that means your line of credit is growing at the same rate. All right. and we talk about if you voluntarily repay some of the loan balance, then you move it off from the loan balance back to the line of credit. We talked about that. The interesting planning implication is that, and this is what a guy named Barry Sachs did the initial kind of research on this stuff back in 2005 or something like that. He was pointing out that you could treat this as a buffer asset, is that if you open a reverse mortgage and keep a loan balance, and you treat it mostly as a line of credit, then it's as though the line of credit is growing at the same rate as the loan balance, but it's not a loan balance. It's a growing line of credit. It's almost like a credit card line of credit that you can tap into later, but it's increasing each and every year, regardless of what your circumstances are. And that is a line of credit that can, and even actually can grow even to the potential of the home value. And here they talk about the impact of a 1% increasing interest rates as you borrow against it when the rates are low, even if you're young and don't anticipate using it. And as the rates get more as you go forward, because your principal limit factor is so much higher when a low interest rate environment, as the rates increase, you can actually see the potential of your line of credit growing even above what your home appreciation value is, which is one of the benefits of doing that. The earlier you take it, the lower the interest rates, the more opportunity it has to grow the line of credit. All right. If you wait, you'll get to borrow more because of the chart. As you get older, the principal limit factor increases, but as I already talked about, not nearly to the extent if you wait until you get older as it does when the interest rates are low. So the time to take out a reverse mortgage is when the rates are low, which is right now. Now, admittedly, the top of the rule change. All right, so it really reflects the value of opening the reverse mortgage before you might potentially need to use it as an asset in retirement so you can get that line of credit growth process beginning. Low interest rates favor the home equity conversion mortgage by helping it to support a larger in principal balance, which means that the larger amount that you can borrow against is growing at a higher clip each and every year as it increases. The line of credit increases each and every year. And then to the extent of the interest rates might rise in the future, it will help to accelerate that growth on a higher principal limit amount. And then on top of that, higher interest rates in the future could just really add huge amounts of opportunity for you. So at the end of the day, going back to Mary, she says, look, I'm going to stay in my house. We don't ever plan on leaving. This is our dream home. We want to die here, essentially, age in place. Well, man, take the thing out ASAP. Just get it locked down, the line of credit locked down, and get it growing so that when you're 90 and you think you need to take money out for long-term care, in-home health care, whatever, you don't have to tap into your IRA. Now, you're going to have to obviously tap into your IRA for required minimum distributions. But what happens if you have to pull $50,000 out of your IRA? Well, you're going to have to pull about $63,000 to cover the taxes. And that's going to affect your Medicare premiums. That's going to affect your Social Security taxes. It's going to put you in a higher tax bracket, which affects your capital gains and affects your qualified dividend rate taxes. What if you pull the $50,000 out from that reverse mortgage? Doesn't do anything. It's completely tax-free. It's return of principal. Has no effect on you whatsoever. So the way I always say it, if you have Roth, Social Security, and reverse mortgage, you pay no tax. None whatsoever. Because all those things are tax-free. When you add them together, they're still all tax-free. Roth, reverse mortgage, and Social Security, completely tax-free. And if you can do that and you're later in retirement and you need money for long-term care, you pull it from the reverse mortgage as opposed to taking it from a growing asset account, which would be your stocks and bonds. Probably not bonds, but anyway, your equities. Ideally, your equities are growing at 6. The cost of your line of credit is growing at 3. Not the cost. Your line of credit is only growing at 3, so you take that money out when you need it. Yes, you will arrest the growth of that line of credit growing because now you owe some money on it, but you're allowing your stocks to compound at a much greater rate, ideally. And either way, it's still tax-free. So the moral of the story, first, go to Don Graves' website. That's HeckhamAdvisorsGroup.com. Get Wade's book again. I'll put it in the show notes, Reverse Mortgages, How to Save Your Retirement, essentially. He's got lots of different articles, Don does, and lots of different YouTube videos that you should absolutely watch as you're considering this. Don't get caught up to the idea that reverse mortgages are a scam. They're absolutely not a scam. Yes, they do cost money. But guess what? Another reason to take out the reverse mortgage earlier. The earlier you take it out, the less it costs you to line it up because it's based on the fair market value of your home. And so the fair market value of your home is $250 today. In the future is $500. Who's going to pay more for the loan cost will be the guy who borrows against it when it's $500 as opposed to the guy who borrows against it when it's $250. So by borrowing against it when it's $250 and you have all the closing costs, you're done with that. If you wait until the house is worth $500,000, it's going to cost you twice just for the same, for actually even a lesser line of credit. Another reason to do it early, because you're going to pay money. I guarantee you. Wade talks about on his book on some ways to minimize some of that, but you will cost some money. But the sooner you do it, the less it's going to cost. Just that simple. All right. As always, what you see here, subscribe down below, comments, thumbs up. If you want to support the YouTube channel, go to my website at heritagewealthplanning.com. There'll be a little link on any of my web pages at the very bottom that says donate. That's my PayPal. I accept PayPal. So by all means, if you get some financial value out of this YouTube channel and you want to support me, please do. I'll be happy to accept your gift. We'll see you guys next time. Thanks now.